What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into these charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a solid-bodied green bar with just a little bit of a lower wick, and it is a significant lower wick. It would simply indicate that the buyers did step up towards the lows, a little bit of initial selling pressure on the week, and most importantly, look at the close of this candle right up at the top of the weekly range, which does strike me as a very bullish takeaway, especially with very little upper wick there, so not a whole lot of selling pressure up there at the highs. So structurally speaking, the buyers definitely have the upper hand here. If we think about location, I think it gets even more bullish, and again, remember the significance of this lower wick, the buyers responding. Why is it so significant? Well, on the bar by bar location count, we do have a higher high and most importantly, a lower low. So this is actually a bullish engulfing bar where we breach the prior week's low. This should have attracted more sellers. It simply did not. Again, that lower wick would indicate that the buyers stepped up. And where did we close? We closed outside of and above the prior week's high. So if we think about the psychology of this, anyone who had a net short position in that red bar there is now, I don't want to say firmly underwater, but definitely starting to feel the heat of the position not working out. So the psychological takeaways of the location of this candle is just as important as the structure closing up at the highs. Some other takeaways from the structural perspective and location perspective. Here we go. Obviously, we've been talking about 390.85 until we're blue in the face, and we've gotten a strong reversal off of that level. We had prior support, which then flipped to resistance. It was a weekly range that we had discussed. On the daily time frame, we know that there's a break and retest right on that level. On the weekly perspective, we've also pointed out that if we take out our Fibonacci's from the lows to the highs, it is the 61.8 Fibonacci retracement, and that is usually a line in the sand. Any subsequent candle closes underneath the 61.8 retracement dramatically increase the odds that you get the full 100% retracement. So the fact that that has held does strike me as a bullish takeaway. For anyone who's been following the channel for a little while now, you'll also remember that we are pretty intent on keeping tabs on our volume profile here on the weekly. Let's get rid of that fib. And you'll remember that this is a high volume node, right? So we've bounced right off of this high volume node. It is currently holding up as support. Remembering that the market likes to move from high volume node to high volume node, that would mean the next target overhead is up here, close to our prior pivot highs, and I'll give you that number, right around 415.75. We'll of course talk about that on the daily time frame in just a moment. One last thing to do before we move on here, if I could get a zoom. Doesn't look like it wants to cooperate that way, so we'll go manual mode. There we go. I just want to point out that there's the possibility of a reversal based on an inverted head and shoulders. Now we know that this is just, this pattern overall is a trend reversal pattern simply because it notes that we have a higher low, number one, and a breach of your neckline gives you a higher high. That would, of course, confirm a new uptrend here on the SPY weekly time frame. But I would say that as long as this holds for a higher low, the trend has already changed. Now, why is that? Well, in past videos, we've talked about how these are your lower highs from here to here to here. Now we have, or had, this higher high from this perspective, higher high from this perspective. All this needs to do is hold as a higher low from here to here, and I would say that the weekly trend has confirmed a reversal to the upside. So just be mindful of that. Of course, you still do have a resistance trend line, but in the short term, I would say that this uptrend is fairly significant in terms of starting a reversal on the weekly time frame. Anyways, let's get on down to the daily and talk about tradable levels into the upcoming week. I'm just going to load the study set here. 50 SMA in blue, 200 SMA in green, and we've got our levels popped on. Does it want to zoom now? Absolutely not. So it looks like we're going to have to do it the hard way today. There we go. In terms of expected move, this is the first thing that we should discuss on today's session together. Last week, we breached it to the upside. So this box represented the shortened trading week, the expected move of that trading week, and obviously we've closed outside and to the upside. So generally speaking, as you get more and more breaches of expected move, it's indicating some sort of inefficiency in the options market that's predicting these expected moves. So can we breach it again this upcoming week? The answer to that would be absolutely 100%. Yes, it would be well within reason to breach the expected move again, and we'll talk about volatility as the video goes on. But the major takeaway for this week's upcoming expected move is the fact that it will produce either a higher low if we respect the bottom end, or just continuation higher for a higher high, notably over our daily resistance trendline, which we'll talk about in just a moment. We closed right on it on the Friday session. So those are some pretty bullish takeaways from just looking at the expected move. Number one, producing a higher low or continuation to the upside. Let's talk about levels. Obviously, we got a hold of that 390.85 that we just saw on the weekly time frame, which to me was fairly surprising given the amount of times we were flirting with it, not on Monday, but really late last week. It really didn't strike me as the best way for an area of support to hold, but nonetheless, of course, we did produce a rally off of it, gapping higher on the Friday session for a gap and go. So I want to talk about that briefly. Obviously, when a gap holds like this and you get no filling of that gap, it's an indication that the sellers are nowhere to be found. So that's actually quite the bullish takeaway. And I would also point out that rallies can start this way. You might think of this as, oh, there's an unfilled gap, it's poor structure, we have to go down and fill it. We absolutely do not have to go down and fill it. Now, can we go and fill it? Yes, the market can always do whatever it wants to do. But from a psychology standpoint, think about the unfilled gap like this. Not only does it indicate that sellers were not willing to step up and quote unquote do their job on Friday, but now anyone who was short in here, and we'll talk about that in just a second on the hourly time frame, is again underwater. We saw that on the weekly, right, with the bullish engulfing bar. But what does that bring about other than short covering? Of course, it brings about FOMO, fear of missing out. So anyone who wants to capture this rally to the upside sees the gap up holding, sellers aren't stepping up. If we breach this resistance trend line and can get over our 411.85 scene of the crime from the breakdown here, I think that draws in a whole new crowd looking for some upside. Anyone who was pretty bummed out about missing out on this rally here certainly does not want to miss it again. And I do think that this could potentially be, if we get the correct combination of things, namely with CPI coming out on Tuesday, PPI coming out on Wednesday, if we get the correct combination of things here, this could lead to an upside move. We'll, of course, look at some more evidence for that as we move through the sectors and the ratio grid. Just to give you guys some numbers, some things to pay attention to early on in the week, if we do see a pullback, the gap fill is the most ideal place for a higher low to form on the daily time frame for the upside to continue to unfold. That gap is from the low of Friday, 402.50, to the high of Thursday, 486 cents. That's kind of like, rainbows and butterflies situation if we see any early week selling. Of course, it also keeps all of these shorts from this box underwater. Again, perhaps the hourly time frame chart does a better job of displaying this. Here we go. You can see support, scene of the crime for the breakdown, lower high, rejection, we gap over it, so we're all good. So anything that pulls back and holds that and remains above does strike me as a bullish takeaway in terms of keeping these shorts underwater. Back to the daily time frame, if we make the move higher, break the resistance trend line, break Friday's high, you're looking at this zone. I would really treat it as a zone, the scene of the crime from the nasty Friday breakdown here, the breach of those two equal lows. 411.85 is the main number I would be focusing on, 411.85. Anything after that, do be mindful of the top of the weekly expected move, but really our next structural level is 419.50. 419.50. If the gap fill does not hold and we do move lower, I wouldn't really want to get chopped around in this area. It would strike me as the possibility for a look above and fail, target the bottom end of the range. I do think, not holding up at that gap would mean 390.85 is back on the table, but one step at a time. We will, of course, update you come the Wednesday video for the midweek market update. A couple of Fibonacci perspectives here on the daily time frame, then we'll get going. Of course, we already talked about on the weekly from the lows to the highs, your 61.8 held. That should not be a surprise, but from the highs down to the lows, what I would point out about this perspective is slightly more interesting, is that Friday's bar actually closed above the 38.2 perspective. So what does that mean? Well, if this was going to turn into a daily bear flag, it would have wanted to remain ideally underneath the 38.2. So this does strike me as another check mark for the bulls into this upcoming week session. So that is the SPY daily time frame chart. Let's take a peek through our sectors now and see what's going on from that perspective. XLC, communications is up first on the chopping block. You'll notice it's just in the midpoint of a range. Here's the trading range. We're literally at the midpoint of that range. So I don't necessarily think that you have a major edge here inside of the XLC. I would say that we breached this and obviously had a strong close above on Friday. That's 55.32. So maybe there's a slight edge to the buyers. Notice the volume as well, really ramping up as this reversal has been underway. That does strike me as a positive force for the buyers, but I'm not overly impressed with the XLC until we can clear 57 with a higher low above that for some sort of structure to build out to the upside. So really more neutral here, but keeping an eye on it based on this volume perspective, what we saw into the end of the week. Slight edge to the buyers here. Next up, we've got the XLY relative strength monster. Remember that our breakout level and equivalent to the SPY 390 would have been in here. It never made it there on the sort of pullback here. And also, the big takeaway on this one is that we've closed above 162.72. Now, why is that important? Because it is the head and shoulders neckline, right? So we are above that. Anyone who was short in here got squeezed out. We talked about the double bottom on the hourly on the midweek market update last Wednesday, and that's continuing to sort of unfold. Notice on Thursday that level held to the tick, and now we're back higher. So bulls definitely have the upper hand here in the XLY, being a heavier weight risk-on sector. That does strike me as a bullish takeaway here. Ideally, any higher low pullbacks want to happen. Use 159 as your line in the sand. XLK, it's got some work to do. This is really where the market's lagging, and I'm not quite ready to say full risk on yet until the XLK really perks up a little bit. And we know that a lot of the pressure on the XLK is due to the TNX, which is the 10-year interest rates, which we'll look at in just a moment. But for now, notice that this flirted much more aggressively with its prior breakout level in here, break and retest, so on and so forth. So I'm not willing to say that there's relative strength here yet. Certainly, as we look at the ratio grid in a moment, it is not there. So the work needs to be done in the XLK, which is likely going to require the TNX and rates backing off a little bit. Now, with the CPI coming out on the Tuesday session, the PPI coming out on the Wednesday session, I'm not necessarily sure that I would position early for any particular outcome of either of those two economic news events. So knowing that, I'm just going to continue to watch the XLK structure. Anything that remains underneath 139 is, we're not out of the woods. This is really just bear flag consolidation from this perspective. If we breach 139, recapture the 50 SMA and put in a higher low above, much better feeling for a bottom in the S&P 500. So continuing to watch the XLK in particular like a hawk because it's teeter-tottering on the edge of just like neutral, sideways, not very impressed with the action here. And of course, we know that this is the heaviest weighted component of the S&P 500. So definitely all eyes on your XLK. Obviously, any interactions again with this level, this sort of zone now around, I'd just call it 132 on the downside, that obviously produces an H pattern, a bear flag, a lower high, whatever you want to call it, and certainly means lower for the XLK. So do be mindful of that situation. XLP, let's move through the other lighter weight sectors a little bit more quickly, swiftly. So here you go. There's a daily trading range in the midpoint of the range. Again, not overly convinced that this is bullish or bearish for the market. Knowing that this is a D for defensive sector, I'm actually quite pleased that this is just hanging out in the midpoint of a daily range. It's not screaming risk off by making new highs, and it's also not providing huge bearish drag underneath the lows of that 72 area here. So neutral strikes me as all good for the market. Energy is where we have some slight concerns. We talked about in the morning updates the move underneath that 78.41 prior breakout level from here, break retest. It was holding at first. We moved underneath for just about a day, and now we're right back above. So this does strike me as turning back into a medium-sized red flag for the marketplace. Higher energy prices is not a good thing for discretionary spending out there from the consumer space, really. But overall, just higher energy prices generally do not bode well for the marketplace. And we also know that just being a lightweight sector, we don't want it to really lead the rally because it's not a heavy weighted component of the S&P 500. So not a great look here inside of energy. Certainly want to see lower highs continuously be produced. Really don't want to break. So just to give you a number here, let me pop on the other tool. To give you a number, I would want to see no breakout over 81. Something that remains here and possibly breaks down would be your ideal look for more of a risk-on look inside of energy. Anything that's higher, just not ideal, right? Obviously you have this as resistance, but it's continuing to display risk-off tendencies by being relatively strong. Hopefully that wasn't too much of a mouthful. Let's move on to the XLI industrials. As we infamously say, 7% of your S&P 500 moving higher over the sort of breakout zone around 94. It does strike me as a step in the right direction. Unfortunately, it's not the biggest weighted component, heaviest weighted component of the S&P 500, so it's not going to make or break us, but it certainly is some bullish pressure for the market. So I'd love to see this continue into the scene of the crime area around 94. 94.97. That does strike me as a healthy sort of piece of support for the bullish case here into the upcoming week. Obviously, you want to hold that 94.11 on any pullbacks for something that does this, higher low on the daily time frame. Next up is the XLV healthcare sector. This is a really important one. Look at the move here in the healthcare sector. Really, really impressed with what happened on the Thursday and Friday session. I thought I was pretty explicit in last Wednesday's video about how we were going to trade this if the move was outside of 127 in the XLV. And I mean, that's kind of exactly what happened here. So this does strike me as a bullish takeaway for the marketplace. There's now the opportunity for a higher low, reattempt for a higher high. You could, really, really ugly. I'm certainly not advocating that this is a textbook inverted head and shoulders, but you get the sense that the trend could start to change here on the daily time frame, which is a big takeaway for your S&P 500, noting that this is the second heaviest weighted component of the S&P 500. So I like what I'm seeing in the XLV. Yes, some people will make the argument that the healthcare sector is defensive in nature. I'm not arguing that it's not, but it is the second heaviest weighted component of the S&P 500, so we can't really do it. We can't, and by it, I mean rally in the SPY, without the help of the XLV. So I do like this move that's unfolding here up and over 127. Bullish takeaway for the upcoming week. Would it be reasonable to find a pullback here? Absolutely. I'm not saying we can't get a pullback here, but the structure would suggest that there's an opportunity now at least for a higher low instead of threatening the breakdown of that 125, which was the critical monthly low. XLRE lightweight sector, let's speed it up here. Not a whole lot to talk about. Back testing the head and shoulders neckline. Strikes me that we might see a little bit of pullback here. If we do, again, such a lightweight sector, it's not going to make or break the day, kind of in the midpoint of this range here. You could draw it in like this and say we're in the lower third, slightly more bearish takeaway, bear flag. Doesn't really matter. I would not be optimally bullish on this particular structure on the daily time frame chart. And of course, as we know, lightweight sector. So we'll move on. Really just a neutral for the marketplace. XLB materials is also a lightweight sector. This has much more of a clearly defined range here. At the midpoint, again, it does strike me as being bullish outside of this congestion area there. So overall, yes, bullish takeaways. Can we find a higher low to fill the gap? Absolutely. Lightweight sector, not going to make or break the market, so we're moving on. Next up, the XLF financial sector, second heaviest weighted sector that we're watching, not by market cap, but by our standard, yes. And I really like what's happening here as well with the move outside of this daily trading range. Break it on Friday, gap up holds on, break it on Thursday, gap up holds on Friday. So sellers not really stepping up here. If we draw in a rough resistance trend line, we're kind of through it, or at least flirting with closing above it, which does strike me as a bullish takeaway. On a relative basis, we're already above the scene of the crime level that we had been discussing in the SPY, as well as the XLY and XLK. So relative strength here, looking for a move, honestly, to that 35-ish handle, the prior pivot high from the sell day, what was that, 2 or 3 Fridays ago now. So overall, XLF does strike me as a bullish takeaway. High probability of a higher low if we can remain above 33.75. Last but not least is utilities. Risk off, red flag, big red flag. Still not loving what I'm seeing here inside of utilities, hanging out at basically all-time highs. Not the look that you want to see. This is D for defensive. We would love to see this thing back off and get closer to the 72 handle. It looked like it was starting to do that, but really Wednesday, Thursday, Friday, as this just exploded to the upside, really not an ideal look is what I will say about the utility sector. So as you can see, just rifling through some of these things, we're starting to border on the edge of risk on, but we're not all the way there yet, which is why I'm a little reluctant to get overly bullish, but there are the sort of green shoots, as we would call them, starting to happen. So if you don't know what this screen is, this is the ratio grid. This video in the top right-hand corner tells you how to set it up. Let's do a quick analysis of our ratios. The top 4 are the risk-on sectors. Remember that we were complaining about the XLK not really pulling its weight, and you can see that clear as day here in the ratio grid. It's obviously pointing to the downside. Little uptick on Friday, but certainly nothing to really read into underneath a fairly neutral 50 SMA. That's the gold line. This does not strike me as a risk-on look. Next up is the XLV. Sure, it's coming from the bottom, and it's interacting with that 50 SMA, so I'll put literally more of a neutral tilde here, but we do know that the daily structure looks quite promising for finding some sort of higher low and continuing to display strength. So I like the XLV, really leaning on more of a small check mark as opposed to that tilde there. XLY, screaming risk on. XLF, screaming risk on as well. The bottom 4 sectors, what's going on here in the risk off world? Obviously the XLP rolling over. That's a decent look for turning risk off. XLE, sideways, risk off, looking decent, kind of just off here. I will say we're still above that little uptrend. Remember that we had ranged out in here. We had a nice little uptrend as it exploded to the upside. Now we're still holding that, but the fact that it's not continuing to the upside. So again, maybe I'll give this one a little bit more of a tilde. It's not all the way risk off, but it's certainly getting there. Real estate looks great, no problems with this one. And again, utilities continues to be the thorn in the side. So we're very, very close to more of a risk on look, risk off, turning off, but we're not all the way there yet, which is again why you hear some of that hesitancy in my voice as I'm sort of walking through these things with you. Let's take a look at the TNX now, which is of course the 10-year rate, and discuss some things coming out with the CPI and the PPI. So overall, what have we been saying about rates and what the market likes? Well, number one, the market likes rates that are stable, so sideways, and number two, the market likes rates that are moving lower. Are these stable? They're getting close to stable going sideways, but I would say overall, this is not stable, and that is obviously not lower. So this is really why we're seeing the pressure in the XLK and a lag in tech. Higher rates are not good for tech companies. And also, we know that CPI is coming out on Tuesday. So let's discuss this very briefly. Right now, the expectation is fairly firm in the fact that the Fed's target rate the rate hike for the month of September will likely be a 75 basis point rate hike. Currently, we're looking at 225 to 250, and the anticipated forecast is 300 to 325. So again, very simple math, 75 basis point rate hike. And we're looking at a 91% probability of that being the outcome. So what I want to point out in terms of the CPI and the takeaway here is that even if the CPI is great and inflation is continuing to tick lower, or at least staying sideways, I don't think that there's very much upside based on good news. I think all of the risk really lies, in the downside. If we get an expectation that misses and inflation does tick higher, I think that there's far more risk to the downside than good news would produce any move to the upside. So that's what I've got for you based on what I'm seeing, not only in the TNX here, literally going sideways, hanging out at these highs, but also that percentage on the forecast that we just saw. So I do think that there is considerable risk based on the CPI and PPI. Jerome Powell has been pretty firm about saying we're going to do whatever it takes to get inflation under control, both based on his comments from Jackson Hole and the most recent talk, which was pre-market on Thursday. So I do think that the market is in store, regardless of what CPI does here, for at least, at minimum, a 75 basis point rate hike, which of course is not ideal for the XLK, which is the tech sector, the heaviest weighted component of the S&P 500. So that has been the fundamental talk for the day. Let's get back to technicals and talk about the VIX, which is the volatility index, or a fear index. What's going on here? Certainly falling out of our 25 sort of floor. Remember that we had discussed this very briefly on Wednesday with the close underneath. We were saying, okay, there's the possibility that we flirt and come back up inside and maybe do something like this, a little bit more firmly moving underneath that. But again, with the risk of CPI and really the risk being all to the downside, I don't think we're out of the woods yet from a volatility perspective. We are not at or below 2050. So volatility is still technically, quote unquote, elevated. And I think with something like this around the corner, all it takes is the wrong sort of information to come out, and we're right back in the box, if not higher. So I'm being prepared for some volatility early on in the upcoming week based on CPI. PPI usually has less importance because the CPI number has already come out and the market's made its reaction. So just be aware of that. Tuesday, before the bell, CPI, it could easily send volatility back inside of here, which of course is where we know the market can get a little bit shaky. We are not in the safe zone yet underneath that 2050 floor. Next up, we've got the VVIX, which is the complement to the volatility index, is the volatility of the volatility index. And I would just continue to point out that the flood effect is still on watch, noting that nobody is really hedging down here. We're at that 85 historic floor, and it's just not really adding up. If we've, to me, there have been some pretty wild, volatile swings in the market. We were really aggressively down. Now we've been really aggressively up the past couple of days with these degrees of correlation, which we'll see on the internals. Let's just go to that screen now, by the way. If you don't know what the internals are, I've got a video for you in the top right-hand corner that shows you how to set this up, what it all means, and kind of how it'll help you make better intraday trading decisions. But what I want to point out between the correlation in the VVIX and the over-correlation, in the actual, stocks on the NYSE trading all, in massive unison to the upside is, why is it that we're seeing this huge correlation? The market's seeing massive throws, really up, down, up, down, up, down. It's either buy everything, sell everything. It's one or the other, right? Why is volatility not expanding more to the upside in this sort of environment where all it takes is everyone deciding, okay, bad news, sell everything, everything goes down. There's no rotation going on, right? It's an all or nothing kind of game right now. And we need to see this correlation settle down a little bit in my estimations, just to make volatility make more sense, if that makes any sense. So I don't know if I just talked in circles, but that's my take on volatility. More of a classical interpretation of our internals here. I do want to point out the strength based on the volume flowing into the market throughout the past week. Really, we look at 300 million as a threshold to say this is significant or this is not significant. If it's below, notice that we do breach it on Wednesday as well as Friday significantly to the upside. So the flows out there certainly are in the bullish direction in terms of what's going on net across the NYSE. So that's going to pair nicely with what we were just talking about as well, with the sellers kind of being stuck underwater and the whole FOMO concept of anyone who missed the rally off of the true lows and is now looking to get in on this pullback. Yeah, the volume's there to definitely support this type of rally. So I would point that out. Again, here's our overcorrelation on the Friday session. I would look out for that to neutralize on Monday. Here's the takeaway. This is kind of simply what I watch for. If we open inside of range on the ES and this pulls back and we're inside the zero line, that counts as being corrected. If we open on a gap up and we're still overly correlated to the upside, that's where I start to get a little bit skeptical that a pullback can happen at any moment, and it's usually going to lead to some liquidation break where the selling is hotter and heavier than you might imagine. So just be prepared for that. Of course, your bullish ticks support the rally to the upside as well. No need to read into that too much. Next up, we've got our market profile. What's going on in the market profile? I want to bring this up because as we were talking about on Wednesday's video, and by the way, if you don't know what this is, don't worry, I've got you covered with all these tutorials, top right-hand corner. As we were talking about on Wednesday, this day right here, this struck me as new money buyers stepping into the market. This was not an indication of short squeeze. We had talked about the P-shaped profile. Well, look at what we got on the Friday session, right here. So as we mentioned, we were above that critical level. We gapped up and over it. So was there some short squeeze in the post of the P here, the letter A period? Could be. It doesn't mean that, again, this just has to all crumble to shreds and these aren't new money buyers and the market's going to collapse here, but it's just one data point that I'm carrying forward as we're moving to the upside without any sort of intraday tagging up, if you will, to these prior points of controls. Some bullish takeaways on the contrary, are that obviously value area is moving higher progressively. Point of control is moving higher progressively as well, which are some bullish takeaways. Let me just zoom in on that high really quick. I didn't think that we had a poor high. Yeah, we don't. Okay, so I was going to say, it looked like we had a poor high when I was zoomed out, but that has been repaired. Decent structure up there at the high. So overall, in the S&P 500, I am of the belief that this could be the beginning of a new rally to the upside if a couple of things happen. Number one, just to sum it back up, higher low pullbacks want to happen above the gap fill level. That's $400.86 in your SPY. After that, we've got to breach the resistance trend line and at least make a move into 411. That's the scene of the crime from here. And that's where I think some new money buyers might look at this and say, you know what? We missed this. It's time to get in and not miss it the second time around. Remember, rallies can start like this. This gap does not have to fill, but if it does, we do want to see it act as support. Anything that's underneath that, really looking for a move back to 390.85 and reevaluating what happens if we get there in the first place. That would set up a bearish H pattern, obviously. So critical levels, if I only had to give you two, 486 cents, 390.85. Those are the two that I would maintain. Anything that's above here, bulls in control. Anything that's underneath, watch your breakdown of that level. So we've hit that home hard enough. Let's get over to the QQQ. See what's going over on NASDAQ land. So the psychology is all the same. Obviously, your resistance trend line is in play. Your gap fill level to hold is 301.90. So 302.85 down to 301.90 is the gap fill. It's a little bit smaller here in the QQQ, but if that does hold, your break is up and over this set of highs at 306. 306 is the number, and then a break of that level gets you to the scene of the crime, the heavier white line there at 313.50, top edge of the weekly expected move. And then we've got 320.35. That's a bit of a stretch. Again, we have been breaching expected moves, but I would not be under the impression that we make it there in the upcoming week's worth of trade. If we follow through underneath 301.90, if we do not get a hold of that level, then I would expect congestion and chop, possibly threatening a breakdown of 292. 292 is your critical downside level from right around in here. Last but not least, we've got IWM Russell 2000 and the small caps. What's going on over here? Currently, a to the tick basically hold of your prior break and retest level. So that does strike me as bullish here. Nice gap up on Friday that held at the resistance trend line. Again, psychology is all the same. We want to see the gap fill hold if we're looking to be bullish for the higher low, 183.76. If that fails, chop, probably looking next for the breakdown of 178. That would be more of a risk off look for our marketplace. And if we get the breach of the resistance trend line, probably looking for the scene of the crime at 190.25 on the upside. Anything past that is just I would look at that as a risk on indication for the marketplace, not be overly concerned with what the levels are that we're trading up into. So with all of that being said, let's get into the core list. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button, share it with a friend, hit the subscribe button, all those buttons, and let's jump right into Apple, see what's going on here. I think the trade setup is quite simple. We've got multiple days of range right here. We had a look below and fail, and we broke the top of the range there on the Friday session. So I am of the belief that Apple can actually see a little bit of continuation higher here. You want to see higher lows happen above on the intraday at least, over 156.50, and we've got some clearance into the 200 SMA and prior rejection point from here, 160.25. Ultimately, a little bit more wiggle room. If you're more of a swing trader, I would start to target 162.25. If we fall back down into the range here and we are not able to hold 156.50, I would be patient. I would not look for trades in this range here, and instead only look for the breakdown once again of 154.15 for some rotation into 150.85. But currently with the close above on Friday, I would have more of a bullish stance here inside of Apple. Next up, we've got Netflix. What's going on? If we zoom in over here, again, very easy trade to identify. We've got ourselves a sideways range. 234 is your upside breakout point. If we can clear that, you've got a bump in the road at 241.25, but ultimately targeting 250, the bottom of our 2 earnings cycles ago. Big, major, deadly gap down, right? So I would watch out for that on the upside if we can breach this range. And also, what do you know? When we're talking about ranges, we're generally looking for range doubles. It basically takes us right to that 250 level. So that does strike me as significant. So 234 is your upside number. If we just play ping pong, day trades are fine. I'm not saying don't do that, but there's nothing to really do from a short-sighted perspective until we can break down underneath 215. If we crack the 50 SMA, if we crack this low, that does open the door into 204.25. Next up, we've got Tesla. A little bit of, momentum coming back into this thing. Nice to see really throughout the majority of the week. Some nice moves there to the upside. Loving that. Anyways, double bottom here on the hourly time frame chart. Let's check it out there. Certainly confirmed with multiple daily bars closing now above that 280.15. So that does strike me as a step in the bullish direction. Remember also, we had been talking about, we really had 2 ranges. You could have called this a look below and fail on that, Wednesday session. And I was personally looking for higher lows above 287.50 to fall more firmly into the bullish camp. Well, that has happened, obviously, right? So I would say bulls are in control. Would it be reasonable to scout a pullback here? Absolutely, as we come into this resistance around 302.50. So just be mindful of that. Momentum is not always going to last forever. Can it continue higher? Yes, but you're starting to push your luck on upside reward based on what's already happened here. So higher low pullbacks, again, think about your gap as the same as what we've been discussing in the broad market. Basically wants to hold 289.50 on the downside and then look for a higher low and continuation back up to this for breakouts and making it all the way to these swing highs. 311.70 is your next upside number. Next up is GOOGL. What's going on in GOOGL? A little bit of a possibility, at least, for a short squeeze. Why do I say that? We've got this big range. You've got shorts that got suckered in on this little doji bar right here. I mean, it looked great. I'm not calling these guys silly. The pattern was there. Everything was there. The market was falling, right? There's bearish sentiment out there, but it's time to possibly call it quits up and over these highs at 110.50. You can imagine that there are probably some stop losses stacked up here. If we breach that and go for a stop run, I could see this thing going easily into that 113.50. If we don't breach this and we just play ping pong, again, intraday trades are fine, but I don't really think that there's anything to do if we're just going sideways in this range. Very, very difficult to trade unless you're quick draw McGee on like a 2 or a 1 minute chart, and so be it. I'm not saying there's anything wrong with that. For shorts, I would want it underneath 106.18 now just to complete the rotation to the prior lows here on the daily around 104. Next up, we've got Meta. What's going on in the metaverse and Zuckerberg land? You can see something very similar. It's not identical, but we've basically got a range, right? We had this 3-day balance, which we were talking about relative weakness on underneath early on in the week, and obviously we've closed above all of that into the close of business on Friday. So to me, there are some bullish takeaways from this chart, but I don't think we're out of the woods yet. I mean, we've got this well-defined daily box, right? And we have not breached the top end yet at 172.56. We know that the XLC has had some relative weakness. I'm not saying it can't continue higher, but this would not be the first place I possibly looked for for long opportunities. Until we can clear this box to the upside, that's where I think, okay, maybe something that does this, sets up a breakout, and then we can start to look at those two equal highs there. So that's probably, for me at least, the more comfortable trade to take, but it does look more bullish than bearish based on the close outside of this micro range inside of the overall range here. So definitely carry forward a little bit of a bullish slant, but I just wouldn't, for me personally, I wouldn't be pushing it to the upside aggressively until we can get out of that. Next up is NVIDIA, all inside bars over the past week, really from that bad news gap down here, starting to flirt with the move into the gap overhead. If we can breach 143.88, clearance into 150 roughly to close that gap. One thing I would be mindful of here is that, this was also a prior range, right? So is this just going to be like a weekly or a monthly break, retest, rollover for lower? It's something to be mindful of, right? So as we close the gap, if we close the gap up around 149.60, 150, be very, very aware of any inverted hammers that start to show up, anything that shows signs of weakness and rollover again. That's where you're probably getting that break and retest scenario. Now, if we blast right through and put in a higher low above, that's obviously a different story. Obviously much more bullish, confirming 150 as newfound support from the prior daily range that we just saw as the chart was scrunched up. If we don't make it through the gap in the first place, again, probably pretty choppy in here. Ideally, the higher low is above. I don't want to use the gap on NVIDIA because these are all inside bars, but the higher low probably wants to be above 136.40 would be my level based on the hourly. If I just zoom in over here, you'll notice that that was, if I could get it in the center of the screen, and I'll just make it pretty for your eyes. There we go. So you'll remember that that was a pretty significant flush point after we had the first gap down, made the rotation and break there. We remained below it. Obviously, a higher low happened above. So to me, if we're going to make steps in the right direction, that can't break down again. If it does, it opens up the door for lower underneath 132.75. Next up, we've got Microsoft. What's going on in Softy? Let's go back over to the daily time frame for a little bit more comfort here. This one still strikes me as being kind of rough in this overall area. I think that, there's no significant daily bar pattern happening in this general zone. We did hold the high of Thursday on the Friday low. To me, the long is up and over 266.65, right? We've got these three equal highs. Again, think about stop losses stacked in there, thin structure off to the left. It just makes sense to me that if we get something that does this and reattempts, that's where the breakout will probably come from. That's the better trade in my estimation for getting a little bit more follow through to the upside. Playing around in here, day trades fine, scalps, whatever, fine, but I don't really think there's a major short to be had in this overall area. So probably patience on the downside for Microsoft. Last but not least, the mini beast. What's going on in Amazon? Then we'll get you those three trade ideas and send you on your way. Certainly, there's your double bottom, just like we've discussed in the XLY, closing back above 132.50, the prior gap level from in here. Strikes me as bullish steps in the right direction. Obviously, closing outside of this double bottom range means that anyone in there who is short is possibly going to close out, adding some buying pressure to the market. Your target is overhead here at 136.70 on the continuation move. Any higher low pullbacks want to hold 130.75 at the deepest. Anything that falls back down inside, you know me, right? I'm not really looking to trade this in the sloppy range. The better short is underneath this double bottom here at 125.25. So boom, look above and fail, gets here, lower highs, boom, then opens the door for lower. Patience will be required for that because currently the chart does look more bullish than bearish. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those good old buttons, and let's dive right into these trade ideas. First one is on MCD for McDonald's. Inside bar setup on the Friday session. 1, 2, 3 bar play, possibly 1, 2. If we breach this, we're looking for 3 to at least get to this pivot high 263 and then see some follow through into this set of highs here, 266.65. You want to see this either consolidate sideways and then break. I would not be interested if we take out the 50 SMA and the hammer low from Friday at 258.10. So bullish trade idea in McDonald's. Next up is BA. This is actually a bearish trade idea. If the market does roll over here, look at this beautiful inverted hammer, short underneath the lows, short under the 50 SMA for a rotation to move back down to the bottom end of this overall range right here. We did close this overhead gap on Friday and rejected pretty firmly off of it. So again, if we need a bearish setup, BA is probably the trade for us, short under the lows and looking to target 151 on the downside. Stop obviously over that high, or just not interested in the trade if we breach and start trading above 158.50. Next up, last but not least, we've got Oxy. Very simple setup based on a 3-bar range, holding the 50 SMA as support. Hammer candle on Friday's session, pointing the wrong way. There we go. If we take take out the high, looking to move through this thin structure. On a day trade, we're looking at 68 as a possible target. A bar that size is well within the range of what can be achieved on any given day here inside of Oxy. If we get follow through after that, that is gravy, and we'll go from there. It's also a pretty nice range double, speaking of ranges. That's going to wrap up the video. Hopefully you enjoyed your weekend. Hopefully we'll see you live at 8:30 for the pre-market prep. And with all of that being said, I wish you a green trading week.